Hello, I'm Anastasia Amoroso, and this is Beyond 60/40. On this show, we do a deep dive into the world of alternative investments and speak with industry leaders who share their insights and expertise on market trends, the macro environment, and investing opportunities. Today, we kick off the show with my market pulse snapshot, and I'll share the one thing that caught my attention this week in private markets. Next, SPF Investment Management Chief Investment Officer Albert Sohn sits down at the desk with me and lays out how the structured credit market is adapting to the current environment. Then, iCapital Managing Director and Head of Platform Partnerships, Jillian Altamura, joins me in the studio to explain how structured investments can help clients express a specific market view. And finally, I'll walk through the benefits of private market fund distribution waterfalls. Let's get to it. In today's Market Pulse Snapshot, the one thing I'm focused on is this: what kind of deals are getting done this year in private equity and venture capital? It's true that the overall private equity and venture capital deal activity is running meaningfully below 2021 and 22 levels, but some deals are still getting done. So let's unpack where these fund managers are deploying capital this year. So first of all, in private equity, leveraged buyouts or LBOs have notably slowed. Of course, they accounted for 50% of private equity deal volumes in 21 and 22, but so far this year, they represent about 38% of the total. Of course, this makes sense and shouldn't come as a surprise because the cost of leverage has gone up significantly and the underwriting of loans by banks has shrunk. Instead, private equity managers are focusing on growth equity. There are 669 U.S. growth equity deals that got done so far in 23, which is 30% more than the 515 buyout deals done this year. This is a first, since we have the data going back to 2008. But this development again makes sense because much less leverage is typically employed for growth strategies, and secular growth in B2B services, tech, and healthcare is alive and well, so higher rates and slower overall economy shouldn't and hasn't been a deterrent. Now shifting to venture capital, the deal count here is down relative to the boomy pace of 21, but that perhaps is not nearly as bad as one might imagine. When comparing that to the 2019 deal counts, deal volumes represent 60% of that year's total. So what kind of deals are getting done in venture? Well, the appetite for angel and seed round deals has waned significantly. Venture deal flow activity has shifted from new startups into more established scale-up companies. For example, late-stage venture now makes up 30% of deal activity versus 25% in 2021. And finally, in terms of the type of companies that are getting VC funding, it is all about software. This sector accounts for 38% of deal count. That's maybe not anything new, and software has long dominated the deal flow count, but in terms of VC deal value, software has definitely picked up this year. It accounts for 47% of deal value in 2023 versus 34% on average since 2013. And when looking under the hood, of course, it is all about artificial intelligence. That's what's driving the interest in software. AI company fundings account for 69% of the top 20 software deals so far in 2023. And while the AI story has taken the public market by storm just this year, this has long been a theme in private markets. In fact, venture capital funds consistently invested in AI companies since 2014, ramped up significantly their investments in 2018, and as a result, today there are 60 times more private AI companies globally than publicly traded ones. So to sum it up, looking at the deal activity this year, which is dominated by growth and tech, to me, the lesson learned so far from last year and this year is this: as investors, we never want to give up on growth, especially in private markets. Rate hikes, recession worries, they come and go, but growth in tech is here to stay. And that's your one thing in private markets this week. Coming up next, SPF Investment Management Chief Investment Officer Albert Sohn joins me at the desk to talk about opportunities in securitized credit. Welcome back to Beyond 60/40. My first guest today is Albert Sohn, Chief Investment Officer at SPF Investment Management, which specializes in securitized credit products. SPF was founded in 2012 and now has over $2 billion in assets under management. Albert, it's great to see you.
Nice to meet you.
Thanks so much for coming in. And, we were just chatting before this, and I know that you've spent over 30 years focusing on structured securitized credit. By the way, including, doing that at Credit Suisse during 2008, 2009. So I want to come back to that at the end. But, focusing on securitized credit here and now, it is a significant portion of the U.S. fixed income universe, which the aggregate universe is 49 trillion and securitized credit is about 27% of that. And yet it's a little bit opaque and maybe a little bit new to a lot of investors out there. So to start us off, what all is included in this big chunk of fixed income that is securitized? And there's a bit of an alphabet soup to unpack there with CMBS, RMBS, CDOs, and so forth.
Yeah, thanks. So yeah, as you said, it is one of the largest markets in the world, always was. And I think what makes it interesting away from that is it has so many different asset classes. So the main ones are mortgages, whether it be residential, commercial, all sorts of consumer credit, student loans, credit cards, auto loans are some of the examples. You also have CLOs, used to have CDOs. You also have bank rec cap, but it's a very complex space with a lot of different asset classes in it.
Right. A lot of different asset classes that I'm sure in a way behave a little bit differently from one another. So we'll get into some of those dynamics. But, if I'm an investor and I'm trying to think about whether I should add something more than stocks, bonds, and treasuries and credit and maybe private credit to my portfolio, why do you think investors should consider securitized as part of their credit exposure?
Yeah, I think because it is such a large market, there's frankly a lot of institutional money deployed towards it already. And I don't know if it's a coincidence, but if you think about like BlackRock and PIMCO, the heads grew up in structured credit. So it's always was a focus and it continues to be a focus. And then I think the other thing about it is it's frankly been one of the scarier sectors over the years. It's had more than its share of volatility. I think a lot of people became aware of it during the 2008 subprime crisis. Subprime mortgages is part of structured credit. But really, it's kind of had its issues going back a long ways. And I think with that volatility and additional risk, if you know where to look, you can get incremental returns. So that's why we think that it's an interesting asset class for all investors.
Yeah, well, we like numbers on the show. So speaking of return, what are you thinking in terms of additional spread or yield or return expectations from this asset class versus some of the other ones?
Well, I know right now, like where we're focused, we're finding stuff somewhere between like LIBOR, SOFR plus 15 to 20, which I think, given how much the market has rallied this year, is hard to find.
Right, now, 15 to 20%, not basis points.
Yeah, so it's still, I think an environment where investors looking for high income with relative stability, it has a lot of opportunities still left despite the rally that we've seen this year.
Right. Well, let's talk about the rally and kind of the here and now, the current market environment. The Fed is most likely going to raise again, possibly in September. And, and yet equity markets have been incredibly resilient or buoyant, I should say, this year. And, looking at the performance of your portfolio, you've done incredibly well last year, being down only 180 basis points where everything else was down, 17, 18, 20%, depending on what you look at. So how does this current environment, bode for your asset class for securitized credit, which is rates potentially a little bit higher, but the economy that's still okay?
Yeah, I think our view right now is still equities is driving valuations across most sectors. I think maybe dissipating a bit, but still the case. And I think that's what makes this environment very tough because I think about some of the extreme opinions out there in terms of, we have another 10 to 15% rally or we're going to have a big correction, and how do you straddle that? So I think for us, when uncertainty is high, we're trying to focus on cash flow. Like people say, cash is king when uncertainty is high. So for us, that's collecting principal and interest from our portfolio, and principal and interest that we think is stable even in extreme environments. So stable even in COVID, stable in 2022. So for the last 3 years, our portfolio has been generating, call it, mid-teens cash flow return, and that kind of cures a lot of ills.
Yeah, it does. Cash is king, or, the way I also like to say it is get paid while you wait.
Sure.
While you wait out this volatility, while you wait out this uncertainty. And it's interesting because the consensus of, equity analysts, who do price targets for the S&P 500, is looking for a move towards 4,800 on the S&P in the next 12 months. That's roughly 9% from here. So if I take the 9% expected on equity returns, versus the mid to high teens on some of the securitized credit products that you're talking about, that's a really attractive proposition. And kind of diving further within that, let's talk about the exact opportunities that you're seeing. So you alluded to mortgage-backed security market, the non-agency side. That's probably where you get the bulk of that yield. So what's the outlook for residential MBS?
Yeah, people are very pessimistic on the housing market. Starting last year, we didn't really go along with it, but certainly the price action was pretty bad last year. I think our view is we're bullish on housing. I think ultimately it comes down to over a long run supply and demand at the house level, and it's an accepted fact that there's a massive undersupply of homes in the U.S. and it's going to exist for years. So it's an asset class that actually starting a few months ago looks like it's kind of bottomed. So we're very bullish on it, and our particular exposure is to borrowers that took out the mortgages 3 years ago. So we believe they have a lot of excess equity built in. So even if we do have another down cycle, we think we at least have some cushion.
Right. Why do you think housing has bottomed? You've got the Fed that may still go another 50 basis points, if not higher, and prices corrected, maybe 8%? Are we really done?
Yeah, it's tough to say. I mean, rates are still obviously very high, but unemployment is still very low. And there's still, I think, consumers have excess savings, although obviously not as much as they used to. So, I frankly think it was more of a stretch to suddenly assume house prices were going to decline a lot and unemployment double. I mean, it could happen, but we're a long ways from there. So we feel like it's not really a surprise. A surprise to me would have been if we saw a huge housing market downturn.
Right. And by the way, again, you've been through the 2008 subprime mortgage crisis, and the issue there was that there's a lot of adjustable rate mortgages. That's not the case at all today in housing, correct?
It's predominantly fixed rate, although we're starting to see a little bit more of the adjustable come back in, order shorter, but it's predominantly fixed rate, and that's certainly our exposure. So yes, one of the interesting thing is, even though we're well past a decade since the GFC, it's still really hard to get a mortgage. I have colleagues that have trouble getting a mortgage. So
right.
It's, I think the mortgages that are being created right now are very different from the ones, obviously in the 2008 period.
Right. So very different on the residential mortgage side, but I wonder what it's like on the commercial mortgage-backed security side. And a lot of people obviously worry about the potential wave of commercial real estate defaults and what would that mean for some of the CMBS tranches. So are you constructive or much less so on the CMBS side?
Yeah, we think commercial mortgages obviously has a lot of problems, and I think our feeling is, while it's gotten cheaper, we do think there's potentially a big wave of supply coming. And our past experience suggests that no matter how cheap the initial pricing is, if there is a big enough wave, the initial leg is going to be lower in valuation. So we're looking at it, but we're not really looking to get involved immediately. We're more monitoring for now.
When do you think the flush out happens in commercial real estate, and when do you think you might see that final buying opportunity in commercial MBS?
I wish I knew. Really it comes down to how much supply actually hits the market and how it gets absorbed. But from a time standpoint, I'm thinking more next year.
Right. And does that require a certain level of rates, or that just requires a period of rates at these levels?
I think it's more about how are these legacy loans getting worked out, refinanced, what new pool of money is coming in to replace, let's say, the banks. Mm-hmm. So I think there are multiple variables. I'm not sure it's as dependent on rates more than just what's going on in commercial real estate.
Right. And with $1 trillion worth of maturities coming up in commercial real estate, it certainly makes sense to sort of sit and wait and see exactly how at least the initial refinancings are being worked out. Speaking of loans that they are not getting paid and the non-performing loans, let's go to the other side of the Atlantic and let's go to Italy and the Italian non-performing loans. That's a part of your portfolio that you also focus on. And, what's the value proposition of Italian NPLs? And it sort of makes me think back to the European financial crisis, back in 2011, where I thought we were getting rid of the, toxic assets. And I thought there were special, vehicles and institutions that were set up. And here we are in 2023 still talking about Italian NPLs.
Yeah, Italian NPLs, Italian banks have been suffering for quite some time. There was a new program introduced in 2019 to help them dispose of the loans faster. That's when we started getting involved. And we started putting this position on when we were still skewing the portfolio to be conservative. And we got questions from investors saying, how is this consistent? And really our view was, when you have a sudden shock risk-off market, where you tend to lose the most money is when a performing asset suddenly becomes viewed as non-performing, because that's when you go from par to something very low. Our view on these assets, we're buying them at 10 to 15 cents on the dollar on average. They've been distressed for a long time. We believe we're buying them at draconian scenarios. So this asset was actually very resilient from a valuation standpoint, and even during COVID. So the way we think about it is we're paying 10 to 15 cents on a dollar. We're hoping to get, maybe additional 10 to 15 cents on a dollar. And really that makes it really about collecting cash flow. It's not about spread or yield. So that's what makes it kind of less correlated to the broader market, which we like.
Right. So if you buy it at 10 or 15, but maybe there's a recovery rate of 30 or 40 cents on the dollar, that's obviously quite a bit of upside.
It's massive.
To the cost basis.
Yeah, sorry to interrupt. It's massive, and basically you just need a few winners to offset losers.
Right. Well, we'll let you pick those winners. But speaking of, performing really well throughout the global financial crisis, I want to go back to that. And you were at Credit Suisse during 2008, during 2009, and for a period of time around that. And you were in the eye of the storm. You were trading and managing securitized products. And so my question to you is, what are some of the lessons learned from GFC that, you carry with you today? And, maybe another part of that question is, what's lurking in the shadows today that, like we didn't foresee, or some people didn't foresee the subprime? What are we not seeing today?
Yeah, I think what I learned during the GFC is, securitized products, because there are so many loans and there's decades of performance, there's a lot of data and a lot of statistical analysis, and it's always been a heavy model-driven business. What happened during the GFC is the performance deviated. And I think the long-time investors were so reliant on the models. When the performance deteriorated, they had a hard time adjusting. I think for us, we took the deterioration at face value and we adjusted. So in some ways, like as always after the fact, it was a pretty easy crisis to trade and to know that we had a big problem. I think right now, this is frankly more of a difficult environment to get the directionality, because back then, if you looked at the data, you knew that you were supposed to go short if you could. Right now, you don't really know whether to go long or short. But I do think one thing more, less scary about today is the outcomes are less extreme. So, 2008, banks are going bust. It seemed like the world was ending from a financial standpoint. I don't think that's the case right now. It's just more about where equity is going to go, where rates going to go, what our valuation is going to go. But we're not talking about the extremes from the GFC.
Right. So the fact that interest rates have risen so much does not make you concerned about, for example, the leveraged loan market and the much higher interest rate burdens that some of those companies have to pay.
No, we certainly are concerned, and I think as a result of that, we have a fairly small exposure to that space, in our opinion. That's why we're really concentrated in some of these assets where we think the high interest rates are going to be manageable. But yeah, I'm not saying there's nothing to worry about. It's just our feeling is it's such a big space. You can pick and choose which assets you pick your concentration in.
Right. But sounds like even though you might be concerned about the leveraged loan market, the size of the concern or the size of the asset class is certainly not on the same scale as subprime was during 2008.
No, subprime was, I don't know if we'll see that again. Hopefully we don't.
Hopefully we don't. Well, on that note, Albert, thank you so much for joining us today. These were fantastic insights. Thank you for helping us understand the world of securitized credit markets and the risks and certainly opportunities that come along with it. Thank you. Next up, iCapital Managing Director and Head of Platform Partnerships, Jillian Altamura, joins me in the studio to talk about structured investments and the evolution of that particular asset class. Welcome back to Beyond 60/40. My next guest is Jillian Altamura, Managing Director and Head of Platform Partnerships at iCapital. Jillian, welcome, and thanks so much for joining me today.
Thanks for having me.
Well, it's great to see you, and obviously we want to talk about structured investments because you spend the bulk of your career in structured investments, and it is still a little bit new and a little bit niche for some investors out there, but tell us about your start in structured investments. I think it was at Goldman.
It was at Goldman. I started in structured investments in finance, really, out of college in 2011. Started on the structured investment team, looked very, very different 12 years ago than it does today, but had the benefit of watching the entire evolution of the asset class over the last 12 plus years.
So how has that changed? How has it evolved? Is it still a niche asset class, or has it grown a lot? What's happened?
Since I started in the seat, the asset class has really taken off. It's very interesting, actually. Even just 3-4 years ago, the asset class in the US was a $40-50 billion a year industry. It's now over $100 billion. That was sales in the US last year. And that's not even talking about, internationally, where volumes are a multiple of what they do in the US.
And what do you think has propelled this growth over the last few years?
There's a couple of different factors that really have kind of helped scale the growth of the asset class. The first is the advent of technology. Financial advisors, when I first started in 2011, financial advisors would call our team, and there were 300,000 financial advisors in the country. We were a team of 10. They would pick up the phone and they would call us and ask us questions around, what are structured investments? How do I deploy them? Can you create this product for me? So the creation of technology platforms and the advent of kind of reframing and scaling those workflows has been a massive tailwind to the growth of the asset class. And I'd pair that really with also the education that now exists around the asset class, because I think one of the real misconceptions around the asset class, even just a few years ago, is that it was hard to access. And so with the creation of technology, with the advent of education and research around the asset classes, it's made it a lot more approachable for financial advisors.
Right. You mentioned, a lot of people maybe don't quite know what a structured investment is. So let's just get back to the basics. And what is a structured investment, and why in the world do I want to get that in my portfolio?
Absolutely. So I think of a structured investment very simply as a customized and tailored way to express a view or to access the market. And there's a couple of different ways that you can implement structured investments. I break it down into 3 main categories. The first is growth-oriented structured investments. These are simply, how can I express a view in the equity markets? The second is income-oriented structured investments. These will complement the fixed income portion of a client's portfolio. How can I access or use structured investments that offer me coupons or a coupon stream to enhance yield? The third one actually plays really well in this market environment, and is actually one of the more commonly traded structures these days, is just simply capital preservation. If I give $100 up front today to invest in a structured investment, can I buy a product that offers me at least that $100 back when the product matures?
Right. And so we'll talk a little bit about the drivers behind each one of these products and the pricing of them, but you mentioned misconceptions. And so what do you think are the most common misconceptions about structured investments today? Is it too complex? Is it too opaque? What is it that's maybe stopping some people from really looking at the asset class?
I think you nailed it. I think there's 2 main misconceptions. The first is structured investments are too risky. The second one is structured investments are too complicated, right? There are so many bells and whistles associated with the product. I think on the first one, structured investments are too risky. Absolutely, there are risks associated with buying the asset class, as there would be buying into any other investment product. For example, these are debt obligations of a manufacturing or issuing bank, so you have to be comfortable taking on credit risk, for example. These structured notes that could be tied to the equity markets aren't paying dividends, whereas if you bought the index or underlier outright, you'd be receiving dividends. So a couple of examples of the risks associated with owning the asset class. But at the same time, you can actually express a view through structured notes that actually matches a more conservative profile. So back to what we were just talking about with principal protection, if you're a conservative or moderately conservative investor, you could buy a structured note that offers you full downside protection to the market. So there really are, of course, risks with owning the asset class, but there are ways to express a more conservative view. The second one about, the bells and whistles, structured investments are too complex. Certainly you could create, through the customization and the tailored nature of the product, a complex structured investment. But you could also express a very clean and simple view to the market using structured investments. For example, you could buy a note that's just tied to the S&P 500, and it offers you upside protection or upside participation, in the same way you could just buy the index or the ETF outright. But it offers some type of downside protection to the market. So while you can create notes that are complex, you can also create very simple payouts as well.
Sure. So, maybe there's some complexity, but at the end of the day, this is a debt obligation of the issuer, and the coupon on that bond is used to put together an options package. So just to dig a little bit deeper on those things, so if it's a bond, it's a function of where rates are. And where rates have been is they were at 0 a couple of years ago. They're over 500 basis points today. The 2-year Treasury note is pushing, 5%, depending on the day. So what does that do for structured note pricing, and how much more attractive is it today because of the rates variable?
Yeah, no, I think this goes back to Finance 101, right? It's rates up, bond prices down, right? And so in this rising rate environment, we're seeing that with bond prices down, what is a structured note? Well, it's a 0 coupon bond. So as bond prices come down, there's more to spend, so to speak, on the optionality that offers you that upside payout or the downside protection. So in this rising rate environment, structured notes are pricing more attractively, and structured CDs for that matter. So structured investments generally are pricing more attractively than they have in quite some time.
Yeah, in at least 2 years, if not more than that. So there's the bond component, which is a rate component, but there's also the volatility.
Yes.
Because the options package is really a function of, what's the implied volatility on the calls or the puts or whatever else might be involved. So it's interesting about volatility because coming into the year, there's a lot of uncertainty. VIX was, very elevated, and all that is done throughout the course of the last 6 months is just grind lower. And here we are sitting with implied volatility levels, gauging by the VIX around 13 or 15, depending on the day. So what does that do to the opportunity set within structured notes? Which ones are more attractive in a low volatility regime versus a high volatility regime?
Yeah, so what's really interesting about structured notes is because you're using an options package to express that view, there are certain types of notes that will be pricing more attractively in a low vol environment, and there's also types of structured notes that will price more attractively in a higher vol environment. So there really is something for every type of kind of vol profile that's out there. In a higher volatility environment, structured note package or options packages that offer downside potential but do put principal at risk where you are selling volatility, that's when those structures will look more attractive. So higher vol environment, products that have downside barriers with leverage on the upside, very clean way to express that view. In a lower vol environment or an environment where vols have normalized, like where we are right now, actually principal protected notes will price very attractively because the options package there is just an upside call where you are a buyer of volatility. So when you're a buyer of volatility, when vols are lower, pricing is more attractive.
Right, and I can think of a very tangible, actionable application of that today, because you think about this year, it's been characterized by this huge monstrous rally in the NASDAQ stocks, for example. If you look at the NASDAQ 100, it's up 37%, again, depending on the day. The S&P is up 15%. So I think there is a sense of unease there that maybe some of these stocks have moved a lot, but nobody wants to miss out on the next leg higher potentially of the AI rally. But why not trade some of that long-only exposure for potentially a structured note that still gives you the long exposure, but it also gives you principal protection or at least a downside buffer?
Now, I think that's exactly the view that people are expressing today. We're seeing a lot of people or investors really who are interested in these short-dated growth notes that offer the downside protection because they're worried about a potential pullback or they have FOMO for not having entered the market when they did, but still can benefit from the upside participation that gives them that long-only exposure to the index.
And for me, that's a really important takeaway about structured notes is that depending on what's happening with rates, volatility, credit spreads, you're going to have a different opportunity set. But thank you for highlighting that particular one that's actionable today. My last question for you, Jillian, is just bring it all together. And how do we think about incorporating all these different flavors of structured notes, principal protection, growth participation, coupons? How do we think about incorporating that into the overall portfolio? And do you take some from stocks? Do you take some from bonds? A little bit of both?
I think that's, and I'm laughing here because that's always been the common question with structured products is a lot of people have siloed structured investments as an asset class that's very static. But as we just kind of walk through, structured investments are anything but static. They're dynamic in that if you have a 60-40 portfolio and you happen to be a more moderately conservative client, you can take from that equity sleeve in the portfolio and allocate to a structured note that has downside protection. On the flip side, if you're looking to amplify the fixed income part of your portfolio, you can take from the fixed income part of the portfolio, amplify with a structured investment that pays a coupon stream. So what's really great about the product set is that when you take a look at the traditional 60-40, if you will, there's an opportunity to employ the asset class across both parts of the portfolio.
Yeah. Thank you, Jillian, so much for sitting down with us today. And this was fantastic information and insights on not only the basics, but the misconceptions and also some of the most actionable ideas of how clients can take advantage of structured investments today. Thanks so much.
Thank you.
Coming up next, I'll give you the basics of what you need to know about distribution waterfalls. Welcome back. Here on Beyond 60/40, we not only keep you up to date on private markets, but also help investors build a foundational understanding of the alternative investment space. So today we're focusing on private market fund distribution waterfalls. In the private market industry, there's a strong alignment of interest between general partners who manage funds and limited partners who invest in funds. GPs typically collect an incentive fee, also known as carried interest, based on a fund's performance of returns earned above a preferred rate of return or hurdle rate. This preferred return is a critical tool that helps ensure fund managers achieve a baseline return for investors before they can collect the share of carried interest. This structure incentivizes GPs to achieve returns above the hurdle rate, but it's important for investors to understand the allocation of distributions between GPs and LPs. This is often referred to as the distribution waterfall, and it has four main components. Number one, return of capital. 100% of the fund's proceeds are distributed to investors until they have received their initial investment back. Number two is preferred return. Investors continue to receive 100% of the fund's proceeds until the fund has reached its preferred return. Number three is GP catch-up. Once the fund has returned all contributions to investors and reached its preferred return, the GP can begin collecting carried interest. There are often provisions enabling GPs to catch up and recoup their share of returns accrued prior to reaching the preferred return. This is done by allowing a GP to return a higher proportional amount of the fund's proceeds until it has caught up to the profit percentage to which it is entitled. And finally, number four, remaining distributions. After the fund manager has caught up and received their pre-specified share of the profits made to investors, the remaining monies are allocated between GPs and LPs at a specified rate, often ranging from an 80-20 to a 90-10 split GP to LP respectively. While these four components are relatively standard across most private market funds, there are variations in how a GP may implement its waterfall. For more insights, please visit our Insights and Education page at iCapital.com. I'm Anastasia Amoroso, and thank you for joining us today. We'll see you next time on Beyond 60/40.